If you want to understand what destroys people in markets, stop staring at the price and start watching the oxygen. That is the first thing I would tell you if you were sitting across from me right now. Most investors believe crashes begin when headlines become dramatic enough for the public to notice. They think the market breaks when the index finally rolls over, when television hosts start speaking in serious voices. When a bank fails in public, when a famous stock drops 30% in a week, that is not when the real damage begins. The real damage begins earlier, in a quieter room, when liquidity starts leaving the system and almost nobody adjusts because the wallpaper still looks intact. I have watched this movie enough times to know that by the time the crowd agrees the room has no oxygen left, the people who depended on that oxygen are already on the floor. That is why I want to give you a different way to think about the market. Not as a scoreboard, as a breathing system. Every risk asset you own depends on a certain amount of invisible oxygen. Cheap credit is oxygen. Abundant liquidity is oxygen. Willing buyers are oxygen. Tight spreads are oxygen. Margin tolerance is oxygen. The belief that somebody will always show up to refinance the debt, roll the paper, absorb the issue, and buy the dip, that belief itself is oxygen. For a long time, the modern market breathed so easily that investors forgot it even needed air. That is always the dangerous phase. The dangerous phase is not when people are frightened. The dangerous phase is when people start confusing stable breathing with immortality. I want you to hold one image in your mind all the way through this. A room can look calm while the oxygen is being drained. The furniture has not moved. The clock is still ticking. The wallpaper still hangs straight. People are even still talking in normal voices. And then, a little later, everything becomes desperate all at once. That is the liquidity trap. It does not arrive as a thunderclap. It arrives as a mismatch between what the eye sees and what the system can still support. That mismatch is what I believe matters in 2026. And if you do not understand it, you will keep reading the market backward. You will think the late-stage surface calm means the system is healthy. You will think a near all-time high means the structure underneath, it must still be trustworthy. You will assume that because the room looks normal, there must still be enough oxygen for everyone. That assumption ruins people. Let me tell you what I mean by liquidity, because the word gets thrown around so loosely that people stop respecting it. Liquidity is not some abstract line item for economists to debate. Liquidity is the ability of a system to absorb transactions without violent price distortion. It is the ability of debt to be refinanced. It is the ability of banks to fund themselves. It is the ability of investors to sell something without discovering there are fewer buyers than the price on the screen implied. It is the ability of the market to carry leverage without immediately punishing the people who use it. When liquidity is abundant, mediocrity looks smart. That is one of the oldest tricks in finance. A weak business can refinance, a speculative stock can levitate, a poor capital allocator can look gifted, a government can borrow too much, a central bank can talk too gently, a portfolio can appear diversified when in truth it is merely floating on the same tide as everything else. Then liquidity begins to leave, and what looked like intelligence turns out to have been buoyancy. That is the first mechanism I want you to remember. I call it the buoyancy illusion. The buoyancy illusion is what happens when rising assets persuade people that the underlying structure deserves the price. In reality, the structure deserved only the oxygen, remove enough of it, and the same assets suddenly reveal what they were always relying on. This is why I do not let myself be hypnotized by the index. The index is the makeup. Liquidity is the blood pressure. You can hide a lot with makeup for a while. Now, if you want to know why I think this period is so dangerous, it is because the system already spent most of the past 15 years refusing to clear what should have been cleared. That is not a moral complaint. It is a structural observation. After the great financial crisis, instead of enduring a brutal reset and forcing the entire economy to rebuild on harder terms, we papered over the damage with zero rates, asset purchases, and a flood of money so large that people began treating it as weather. A great many investors built entire lives, careers, and philosophies on that weather. They learned the wrong lesson from the wrong climate. They learned that every collapse is a buying opportunity because the Fed will always find a way. They learned that debt is manageable because borrowing is cheap. They learned that duration is harmless because rates live in the basement. They learned that broad market exposure automatically equals prudence. They learned that the most expensive stocks can stay expensive forever, if enough liquidity keeps drifting into the same crowded corners. Those were not eternal truths, those were conditions. and conditions age when inflation came back. The bridge between old pricing and new reality started to strain. Rates rose, debt costs rose, the government's interest burden rose, and now we have reached a very uncomfortable place where the old answer to every crisis, cut rates, flood liquidity, and reflate everything, no longer arrives without consequences large enough to scare the people who would otherwise deploy it. That is the second mechanism. I call it the rescue trap. A rescue trap forms when the medicine that once saved the patient now threatens to worsen a different disease. In the past, the Federal Reserve could cut aggressively and flood the system because inflation was tame enough, or at least tame enough for the market to tolerate the response. But when inflation remains sticky and the debt burden is enormous, every act of rescue begins to look like an admission that the system cannot survive honest rates for very long. That changes the psychology of the entire market. A central bank that cuts from strength reassures. A central bank that cuts from constraint alarms. A central bank that prints from confidence stabilizes. A central bank that prints because it is trapped weakens trust. That is where things get especially dangerous, because modern investors have been conditioned to treat all easing as bullish by default. They no longer ask why the easing arrived, what had to break to force it, or what it says about the system's tolerance for normal financing conditions. They just cheer the first headline and forget to examine the wound that made it necessary. I have seen this kind of confusion before. In the late stages of a bubble, the crowd begins calling every unpleasant signal temporary and every rally proof. They always say the same sort of things. The old rules do not matter. Fundamentals will catch up. Liquidity will stay. It is a new era. It is a new paradigm. Some version of that story returns in every cycle because human beings hate the thought that prosperity can be conditional. But prosperity is always conditional. The market is never paying the same price for the same asset under all monetary and credit conditions. The price reflects the air in the room. That is why I say the setup can be worse than an earlier crisis, even while the surface looks better. In the final stretch before a break, the market can still smile. That is not comfort. That is anesthesia. Now let me explain the actual trap the way I see it, because if you are going to survive it, you must stop thinking in headlines and start thinking in stages. The first stage is the illusion stage. In this stage, rates are higher than people would like, but the market still behaves as though plenty of oxygen remains. Why? Because other channels are quietly offsetting the squeeze. Treasury cash gets drawn down. Residual liquidity lingers. Big cap names continue carrying the index. The average observer sees a healthy surface and concludes that tightening is not really biting. He says, look, the market still goes up. He thinks that settles the matter. It settles nothing. The illusion stage is dangerous precisely because it flatters shallow analysis. The surface keeps rewarding people for not asking deeper questions. That makes them more committed, not less. A long illusion is one of the cruelest gifts a late cycle can offer because it lets the crowd become overconfident at exactly the wrong time. The second stage is the squeeze. This is where I believe we are already living, whether the average investor recognizes it or not. The easy offsets are gone or fading. The Treasury cannot keep draining old reservoirs forever. More funding has to happen in the open market. More debt has to be absorbed. More liquidity is pulled into financing the government itself, rather than drifting through the financial system as loose speculative air. This is what most people miss. They think a debt problem is a future history book problem. In truth, it is a present liquidity problem. Every dollar sucked into servicing and refinancing a gigantic debt load is a dollar not easily available to keep every corner of the asset market levitating. The drain begins quietly. Spreads widen in places that do not make headlines. Small caps weaken while the index still smiles. Trading depth thins. Riskier credit starts behaving differently. Some offerings need more inducement. Some borrowers need more generosity from lenders. Under the surface, breathing gets shallower, and because the biggest stocks can still mask this process for a while, the crowd keeps misunderstanding what it is seeing. The third stage is the break. This is when the room finally behaves like the oxygen that left it. Something regional snaps, a bank stumbles, a funding market hiccups, a private equity structure gates withdrawals, a corporate deal gets pulled, a corner that everyone had assumed was manageable suddenly becomes the place where forced selling begins. The media calls it isolated. That word is always a warning sign. Isolated means the narrative is still trying to contain a pattern that has already begun. Then comes the ugly part. Correlations rise. Things that were supposed to offset each other start falling together. Margin turns into a weapon against the people who thought they were using it intelligently. Credit spreads say what stock prices were too vain to say earlier. And the investors who thought the index told the whole story discover that the index had simply delayed their education. That is the third mechanism. I call it the surface lie. The surface lie is when a headline benchmark continues looking healthy long enough to keep people from examining the damage spreading underneath it. You saw versions of this before. The cracks appear in one part of the system first, then in another, while the broad public stays focused on a handful of surface numbers. By the time the lie becomes impossible to maintain, the repricing is no longer polite. I have seen too many people misread that period. They tell themselves that if the surface still looks fine, caution is cowardice. They tell themselves that because the crowd is still celebrating, the risk must still be theoretical. They tell themselves that a prudent reserve is missed upside. Then the break arrives and what looked like missed upside turns out to have been preserved authority. That brings me to the part most people care about, but very few think about correctly. What do you actually do? Not philosophically, practically. When I think about navigating a liquidity trap, I do not think in slogans, I think in buckets. Money without buckets turns into emotion. Buckets create behavior. So let me give you the 5-bucket structure I would use in a world where oxygen is leaving the room. The first bucket is cash and treasury bills. Not because I have forgotten how inflation works, not because I want my money to take a nap, but because in the late phase of a cycle, cash stops being an idle asset and becomes strategic oxygen of your own. Cash gives you time. Treasury bills give you yield without making you hostage to long-duration repricing. And most importantly, cash gives you the one thing leveraged and fully committed investors will not have. When the real markdown arrives, the ability to choose rather than react. The crowd treats cash as performance drag. I treat it as future buying power. If I am earning a reasonable short-term yield, while others are stretching for the last few scraps of upside in crowded assets, I am not losing a race. I am preserving firepower. A crash is where money learns who stayed liquid. That lesson is brutal. The people who can still buy are the people who wrote the next decade's returns. The second bucket is targeted downside exposure. I am not talking about turning yourself into a theatrical permabear. That is another form of ego. I am talking about recognizing that when the room loses oxygen, the most overvalued, most debt dependent, most liquidity. Sensitive assets typically suffer first and most. Some businesses only work in a world of cheap financing and generous investors. Some sectors are still carrying assumptions that belong to another era. Some indices are so concentrated in the same few names that the supposed safety of broad exposure becomes a joke. That is where selective short exposure, or simple defensive instruments, if that is the only tool you understand, becomes less about showing off and more about admitting that the market is not a moral poem. It is a system of claims and prices. When claims are mispriced, someone should eventually profit from their correction. The third bucket is precious metals, particularly through productive exposure rather than only passive exposure. I do not need gold because I think civilization ends tomorrow. I need gold because governments, by their nature, eventually discover that debt is more politically manageable when the unit of account is made less trustworthy over time. Gold does not solve every problem. It simply refuses to be printed into obedience. In a world where the rescue trap is active, where the easiest policy response to deep stress is always some version of dilution that matters. And if I want torque on that exposure, I do not stop at the metal. I think about the businesses producing it. Because when the metal moves, the operating leverage inside those businesses can turn a serious trend into an extraordinary one. Silver adds another layer because it is not only monetary, it has industrial hunger behind it. It does not always move when you want. But when the system begins repricing trust and real asset scarcity at the same time, silver can behave like a metal with unfinished business. The fourth bucket is energy. This one should not surprise anyone who thinks honestly. You can create money with a keystroke. You cannot do the same with a barrel of oil or a cubic foot of natural gas. Energy remains one of the most direct ways to own something the world must keep using while policymakers are busy trying to manage the consequences of their previous generosity. If inflation reaccelerates because the rescue trap is sprung again, energy is one of the few places where the pain in the system can become your protection. The fifth bucket is defensive necessities: toothpaste, soap, basic household goods, basic food, medications. Services and products, people keep buying because life keeps going, whether the market is celebrating or gasping. Businesses with real pricing power, real cash generation, and products that do not require optimism to sell deserve more respect in a liquidity trap than they usually get in a liquidity flood. During the age of easy money, investors tend to confuse excitement with quality. In the age of oxygen loss, durability becomes attractive. Again, that is the portfolio logic, not one giant wager. A breathing system of your own cash for authority. Downside exposure for asymmetry, metals for monetary distrust. Energy for inflation reality, staples for durability. Notice what I am not doing. I am not chasing the most beloved growth narratives at heroic multiples. I am not pretending concentration in a handful of giant stocks is the same thing as prudence. I am not confusing the market with a small cluster of mega cap names that can temporarily hold up the whole facade. I am not betting my future on the hope that rescue will arrive with no new cost. This is another important identity shift. You must move from being a passenger to being a steward. A passenger assumes the ride continues because it continued yesterday. A steward checks the fuel, the pressure, the route, and the condition of the vehicle. A passenger asks whether the market feels good. A steward asks whether the system can still finance itself cleanly. A passenger wants reassurance. A steward wants the truth. That truth often looks boring before it looks right. You have to make peace with that. If your strategy only works when the crowd already agrees with it, then it is not strategy, it is social borrowing. Now let us talk about signals, because I do not believe in vague fear. Fear without signals turns people into fools. The point is not to tremble. The point is to observe. If longer duration yields move into territory that says the bond market is demanding real compensation to hold sovereign promises, I pay attention. If regional banks, the weak links in many funding chains, start behaving like the hidden losses on their books are about to become public, I pay attention. If credit spreads begin widening in earnest, I pay attention. Why those? Because when oxygen leaves the room, the funding structures notice before the headlines do. Stocks can stay vain for a while. Credit is usually less vain. Banks can look stable until they do not. Funding markets can look deep until they suddenly are not. You do not need to predict the exact day the bridge shakes. You only need to know which cables are taking the strain first. Now let me tell you the one mistake that destroys more investors in an environment like this than almost any other. They marry the story they told themselves at the top. They become loyal to their own opinion. They identify with their allocations. They decide that changing posture means admitting personal defeat. That is childish and expensive. I have never cared about being right in a theatrical way. I care about being correctly positioned. If the facts change, I change. If the market tells me the room has more oxygen than I thought, I can adapt. If it tells me the drain is accelerating, I can adapt. Ego is the enemy in all investing, but it is a particularly murderous enemy during a liquidity event because timing matters as much as direction. I learned that long ago. Being right about the destination while wrong about the path can still break you. That is why buckets matter. Buckets keep you from turning analysis into a crusade. They let you move, they let you respond, they let you preserve your authority while the market keeps trying to provoke your identity. That is the fourth mechanism. I call it ego drag. Ego drag is what happens when your self-image becomes heavier than your judgment. You stick with a position not because the evidence supports it, but because backing away would wound the story you tell about yourself. The market loves investors with ego drag. It can drag them much farther than they ever imagined. What I want instead is disciplined flexibility. Be strong in principle, be flexible in execution. Principle says oxygen matters. Execution says I will follow the evidence of oxygen loss and act when it appears. Principle says dead arithmetic matters. Execution says I will not wait for the crowd to approve my caution before I become cautious. Principle says liquidity crises hide under healthy surfaces. Execution says I will look under the surface, even while everybody else is complimenting the wallpaper. That is how you survive a liquidity trap. Not by becoming a prophet, by becoming a reader of structure. Now I want to tell you what happens on the other side, because fear is useless unless it ends in a protocol. When the break finally comes and policy panic follows, most investors will still be reading it wrong. They will think the first big rescue signal means all clear. I do not. I treat rescues as information. If authorities are forced to restart large-scale support, they are admitting that the room truly had less oxygen than people thought. That admission can eventually create extraordinary buying opportunities, but only after the first leg of forced selling has done its work. This is why patience matters so much. The investor with no dry powder experiences a crash as assault. The investor with dry powder experiences it as inventory formation. That sentence may sound cold. It is not meant to be cruel. It is meant to be honest. Markets do not ask whether you deserve your opportunities or your pain. They simply reveal who prepared. When the market hands extraordinary assets to the patient at prices that only exist once or twice a decade, the people who were fully loaded into the old regime will not be able to respond. They will be too wounded, too emotional, too trapped, or too exhausted. The people with cash, courage, and a clear framework will write the next ownership map. That is why I say the trap is already here. Not because every visible symptom has arrived, because the arithmetic is already draining the room, because the illusion stage has already flattered too many people into complacency, because the squeeze is already operating under the surface, because the break, whenever it finally chooses its form, will catch a public that still confuses index altitude with systemic health. I am not asking you to panic. Panic is what people do when they waited too long to think. I am asking you to take structure seriously. Think in buckets. Think in oxygen. Think in optionality. Think in who must refinance, who must fund, who must roll, who must borrow, who can still breathe if the room gets thin. And above all, remember this. A market can look healthy while the oxygen is being drained. A portfolio can look diversified while it is quietly one big bet on the same easy conditions. A saver can feel conservative while he is fully hostage to the same giant liquidity machine as everyone else. Do not let familiar surfaces fool you. The most expensive lies in finance are often the calmest ones. If you understand that, truly understand it, then you are already thinking more clearly than most investors who will walk into the next phase without a playbook and call it bad luck. It will not be bad luck. It will be oxygen they never notice leaving. And by then, the prepared investor will already have decided how he wants to breathe.